wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets, and we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 213, and in this episode we're reviewing the performance of the financial markets during the 20th week of 2026, and that is from Monday the 18th to Friday the 22nd of May. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where the incoming Federal Reserve Chair, Kevin Warsh's talk about regime change at the central bank has generated speculation about everything from interest rates to major personnel changes to fundamental alterations in the way it operates and communicates policy. But what that eventually might look like is subtler but perhaps more consequential, which is a rethink of how the Fed manages the financial plumbing in the US economy and the mammoth balance sheet it has built over the past 18 years fighting financial crises. Interviews with former Fed officials and economists suggest that Warsh could guide the Fed to a smaller role in day-to-day financial markets, while also setting rules for how and when the Fed should intervene. Simply stated, the debate centers on whether the Federal Reserve should continue using its balance sheet as a regular tool for influencing financial conditions and supporting markets, or reserve it for periods of extreme market dysfunction and economic stress. Moving over to China, where China's economy stumbled in April with consumption, industrial output, and investment growth missing expectations as the fallout from the Iran war dampened momentum in the world's second largest economy. According to data released by the National Bureau of Statistics on Monday, retail sales grew by 0.2% in April from 1 year ago, sharply missing economy's forecast for growth of 2% and slowing down from 1.7% in March, and this marked the weakest growth since December 2022. China's industrial output increased by 4.1% in April, decelerating from a growth of 5.7% in March and undershooting expectations for an increase of 5.9% based on a Reuters poll. And over to the Far East, where Japan's core inflation eased more than expected in April, falling to its lowest level since March 2022 and potentially weakening the case for an early rate hike by the Bank of Japan. Core inflation, which strips out prices of fresh food, came in at 1.4%, which was lower than the consensus forecast of 1.7% and was also below the March reading of 1.8%. Headline inflation came in at 1.4%, down from 1.5% in March, and was the fourth consecutive month that headline inflation came in below the central bank's target rate of 2%. Meanwhile, double core inflation, which is closely tracked by the Bank of Japan and which strips out both food and energy prices, this fell to 1.9% in April, down from 2.4% in March. And despite the war against Iran, energy prices in Japan fell by 3.9% in April, compared with a decline of 5.7% in March, and this was mainly due to fuel subsidies by the government of Japan. In the United Kingdom, the collapse of market financial solutions continues to reverberate across the broader financial services sector and comes amid deepening fears that stress in niche credit markets could spill over to the broader banking system. Market Financial Solutions entered into insolvency on the 25th of February amid allegations of fraud. MFS was a specialist mortgage lender that provided bridging finance, which is a type of short-term loan that is offered to clients who are asset-rich but cash poor. The company had a total loan book that was estimated to be worth more than £2.4 billion. And on Wall Street this past week, stocks rose on Friday as Treasury yields eased off, resulting in a winning week for Wall Street despite heightened volatility in the markets. It remains unclear whether the US and Iran are moving closer towards a deal to end the war, as Reuters reported on Friday that a Qatari team, in coordination with the US, flew into Tehran to help secure an agreement to end the conflict. All the three major indices closed in the green on Friday, with the Dow Jones Industrial Average gaining by 294 points as it posted another record close at 50,579. Meanwhile, the S&P 500 rose by 0.37% to settle at 7,473, and the tech-heavy Nasdaq Composite climbed by 0.19% before settling at 26,343. And in related news, Elon Musk's SpaceX is officially headed for the public market, with the company planning to list on the Nasdaq following a confidential filing with the Securities and Exchange Commission in April. This historic move is poised to be a record-breaking public offering, and once completed, it will put Elon Musk at the helm of two separate trillion-dollar public-traded companies. Historically, IPO access has been strictly reserved for Wall Street's largest financial institutions, but in a major departure from this traditional playbook, retail investors are getting unprecedented direct access to one of the hottest IPOs in the market this year. According to the Securities and Exchange Commission prospectus released on Wednesday, SpaceX will sell a portion of its shares directly to retail investors through major trading platforms such as Robinhood, Fidelity, and Charles Schwab. In the bond market, U.S. Treasury yields were mixed on Friday as Kevin Warsh took over the reins at the Federal Reserve. The volatility in the bond market came as U.S. President Donald Trump swore in Kevin Warsh as chair of the Federal Reserve on Friday. Bond investors are looking for signs of whether the new chair will comply with Trump's call to cut interest rates even further, despite the risk of higher inflation. Meanwhile, the US and Iran have signaled progress in talks to end the war, but remain divided over Tehran's enriched uranium stockpile and the issue of tolls for passage through the Strait of Hormuz. The yield on the 2-year Treasury note, which closely tracks the Federal Reserve's interest rate policy, this traded up by more than 3 basis points to close at 4.12%, whilst the yield on the 10-year Treasury bond, which is a key benchmark for U.S. government borrowing, this fell more than 2 basis points to settle at 4.55%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, oil prices were sharply lower this week as the US and Iran signaled progress in talks to end the war. However, both sides remained divided over Tehran's enriched uranium stockpile and the charging of tolls for passage through the Strait of Hormuz. U.S. Secretary of State Marco Rubio on Thursday said that there were good signs of an agreement to end the conflict, but warned that any such deal would be unfeasible if Iran pursues measures to control shipping through the Strait of Hormuz. Brent crude fell more than 5% this past week, whilst the U.S. benchmark lost more than 8%. Prices tumbled after President Trump called off an imminent strike on Iran in order to allow for more negotiations. The international benchmark Brent crude added 96 cents on Friday to close at $103.54 per barrel, whilst the U.S. benchmark, that is West Texas Intermediate crude, advanced by 25 cents to settle at $96.60 per barrel. And in related news, the head of the International Energy Agency warned on Thursday that oil markets could soon enter a red zone as global stocks continue to deplete and as demand picks up during the summer travel season. The executive director of the International Energy Agency said that the single most important solution to the current energy shock was a full and unconditional reopening of the Strait of Hormuz. The director noted that if the strait remains closed and no new oil is flowing from the Middle East, then the ongoing drawdown in global stockpiles, combined with an uptick in demand during the summer travel season, means that oil markets may enter the red zone either in July or August this year. In the precious metals market, the price of gold fell on Friday and was headed for its second straight weekly loss, pulled lower by a stronger dollar and rising oil prices that kept inflation concerns in focus and increased the chances for a U.S. rate hike in the near term. Soaring energy costs tend to drive up inflation and could prompt central banks to keep interest rates higher for longer, which further weakens demand for non-yielding assets like bullion. According to the CME's FedWatch tool, traders are now pricing in a 58% chance for at least one interest rate hike of 25 basis points by the Federal Reserve before December. In response, the price of spot gold was down by 0.8% for the week before settling at $4,502 per ounce. We now change scene to the Kenyan financial market, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling dipped by 30 cents versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.57, compared to a rate of 129.27 that was recorded the previous week. Meanwhile, the sterling pound was priced at 174.02 and the euro was valued at 150.56. And on the regional front, one Kenyan shilling was changing hands for 29.13 Ugandan shillings and 20.18 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.28. The International Monetary Fund has previously raised concerns about the extreme stability of the Kenyan shilling, but the central bank continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar-shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined sharply by a massive $296 million for a grand total of $13.21 billion, which is equivalent to 5.6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default, which the country came close to in June 2024 with the maturity of Kenya's debut Eurobond for $2 billion. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the current central bank rate. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 6 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 21st of May, and the central bank received bids totaling to 30 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 125%. The central bank ended up accepting 26.1 billion shillings, and the results of the auction were as follows. The 91-day rate increased by about 7 basis points to settle at 8.38%, whilst the 182-day rate was flat for the third week in a row at 8.21%, and the 364-day rate ticked up marginally by about 2.5 basis points for a weighted average rate of 8.58%. Please note that over the past 4 weeks, the yield on the short end of the Treasury bill market has been rising steadily, and this is on the back of the first supplementary budget for 2025-2026, which pointed to a massive increase in the domestic borrowing target of about 360 billion shillings. And in addition to that, the latest data shows that inflation is now trending higher, mainly due to the impact of rising fuel prices. We should therefore expect more upward pressure on interest rates as investors park their funds into the 91-day Treasury bill, which gives them an opportunity to reinvest at a higher rate in the short term. In the primary bond market, the Central Bank of Kenya has published a prospectus for the reopening of 2 fixed coupon treasury bonds, in which it is looking to raise a total of 50 billion shillings for the stated purpose of budgetary support. The auction for these 2 treasury bonds was held on Wednesday, the 20th of May, and the central bank received bids totaling to 47.1 billion shillings against an advertised amount of 50 billion shillings, representing a performance rate of about 94%. The central bank ended up accepting a total of 36.5 billion shillings, and the outcome of the auction was as follows. For the first bond, which is a 15-year bond that was initially issued in 2019 and now has 8.3 years left to maturity, the central bank accepted 14.4 billion shillings at a weighted average rate of 12.97% compared to the bond's coupon rate at 12.34%. And for the second bond, this is a 20-year bond that was initially issued in 2021 and now has 15.3 years left to maturity. The central bank accepted 22.1 billion shillings at a weighted average rate of 13.74% compared to the bond's coupon rate at 13.44%. And on Kenya's national debt, according to the latest data from the central bank, Kenya's national debt as at February 2026 stood at 12.84 trillion shillings, and this was divided between domestic debt, which stood at 7.06 trillion shillings, and foreign external debt that is valued at $44.79 billion, which is equivalent to 5.77 trillion shillings. A recent debt sustainability analysis described Kenya's debt as manageable, but also highlighted a high risk of debt distress. And in response to this, the National Treasury has developed a medium-term debt management strategy that aims to reduce the debt-to-GDP ratio from 64% down to 57% by 2028. For your information, Kenya's debt ceiling limit was converted to a debt anchor that is now set at 55% of the country's gross domestic product. And given that our current debt-to-GDP ratio is estimated at about 70%, this means that the government is in breach of its own borrowing target. Up next is our topical issue, and this week we are looking at 2 issues. The first issue is on Kenya Revenue Authority's proposal to tax 60% of unexplained retained earnings. The Finance Bill 2026 is proposing to give the Kenya Revenue Authority powers to tax a minimum of 60% of unexplained retained earnings. What this means is that if your company is sitting on profits that you cannot justify distributing as dividends, then the Kenya Revenue Authority will treat 60% of your total retained earnings as deemed dividends and charge withholding tax on that amount. For your information, local investors pay 10% withholding tax on dividends, whilst foreign investors pay up to 15%. So what that means is that the free ride of parking profits in retained earnings in order to avoid shareholder payouts and the subsequent payment of withholding tax is now under review. And the second issue is the ruling by the Supreme Court that pension funds are private trusts. The Supreme Court has struck down a law subjecting pension schemes sponsored by public entities and state corporations to the strict public procurement system, ruling that workers' retirement savings are private trust funds and not public money despite being linked to state employers. In a landmark ruling expected to reshape governance, investment operations, and oversight across the country's retirement benefit sector, the court held that pension schemes handling funds from government workers are not public entities subject to procurement laws. The five-judge bench, led by the Chief Justice, ruled that pension funds linked to public entities are not public money that is subject to the Public Procurement and Asset Disposal Act. According to the court, pension savings cease being public funds once contributions are remitted into retirement schemes that are established as irrevocable trusts under the Retirement Benefits Act. The court declared Section 2.0 of the Public Procurement and Asset Disposal Act as unconstitutional to the extent that it subjected pension funds to public procurement systems. It further held that pension schemes are private trusts and not state bodies performing public functions. The ruling hands a major victory to the Association of Retirement Benefit Schemes, which argued that procurement rules increased administrative costs and slowed down investment decisions. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, everything you've ever wanted is on the other side of fear. A quote by George Adair. Think about it. Thank you, and God bless.